Arm dropped 7.8%, and everyone is panicking. The core signal shows Arm's royalty engine rests on two hardware realities that no rival can copy. Those realities lock in perpetual chip design fees across every smartphone, tablet, and emerging AI device worldwide. The Moat score is 88 out of 100, high durability. Here's what the business evidence says. What operating evidence matters most for Arm Holdings plc? Arm's ecosystem royalty moat is structurally anchored by two unassailable hardware realities that competitors cannot easily replicate. And another question, what could weaken Arm Holdings plc's moat durability? However, the bear case presents a formidable structural challenge that bulls cannot ignore, reflected in an elevated short float. Short float percentage, the proportion of publicly traded shares sold short by traders betting on a stock price decline, of 12%. Walk the AI stack, and Arm sits as a Tier 1 bottleneck, controlling CPU instruction set architecture, IP licensing. The moat here is ecosystem royalty, and it should hold for very long. Arm sees AI licensing momentum and strong stock gains in H1 2026, indicating accelerating demand for its IP. The one force that could crack it, RISC-V server adoption, 5+ years away. Qualcomm licensing dispute. Mainstream momentum traders are panic-selling Arm alongside physical chip manufacturers, treating its architecture licensing business as if it were burdened by the same capital expenditure and inventory risks dragging down silicon fabricators. The market is aggressively pricing in near-term cyclical friction, assuming that declining chip manufacturing build runs will immediately crush royalty cash flows. What Wall Street is pricing is broad hardware weakness, effectively treating an intellectual property platform like a cyclical component maker. This sentiment shift ignores the structural insulation of licensing. While the market panics over short-term hardware shipments, retail traders are focused on the upcoming quarterly report as the ultimate test of Arm's pricing power. To judge whether the market's panic is justified, we must look directly at the silicon microarchitecture rather than stock charts. Arm does not etch silicon or manage physical fabrication plants. It licenses ISA, instruction set architecture, the standardized software-to-hardware boundary interface that defines how a processor executes computer code. The real driver of Arm's financial expansion is the generational migration from legacy Armv8 to Armv9, which integrates SVE2, Scalable Vector Extension 2, an architectural instruction set upgrade that doubles parallel data processing throughput for on-device machine learning math. This architectural leap allows Arm to command double the royalty percentage per physical processor compared to prior generations. The engineering evidence is unequivocal. Hyperscalers are not adopting custom Arm silicon to save upfront cash, but because x86 hits a physical power wall in high-density rack configurations. Physical silicon efficiency proves that Arm's ecosystem royalty moat is strengthening, not collapsing. Quarterly financials showing modest revenue momentum for Arm. The Federal Reserve's restrictive stance is vividly reflected in the benchmark 10-year Treasury yield sitting at 4.69%, even as consumer price index inflation decelerates to 0.6% year-over-year and unemployment holds at 4.2%. This environment presents a dual reality for technology capital expenditure. However, high discount rates amplify market sensitivity for high-valuation intellectual property licensors. When debt financing costs stay elevated, corporate CFOs tighten R&D budgets, scrutinizing upfront architecture licensing fees even as revenue growth trends at 20.1% year-over-year. Compounding this monetary friction is heightened policy uncertainty stemming from newly proposed federal tariff structures and international trade renegotiations. As trade rhetoric escalates, multinational hardware vendors face potential cost increases on physical component supply chains, driving executive management teams to reevaluate their long-term silicon commitments and defer upfront licensing agreements. In response to trade war friction, technology companies are increasingly shifting away from capital-intensive merchant processors toward custom domestic chip architectures. When tariffs threaten to inflate imported chip costs, hyperscalers turn to custom internal designs to preserve operating margins. Because Arm taxes the architecture layer regardless of who manufactures the physical silicon, Regulatory friction against third-party chip suppliers paradoxically accelerates the long-term adoption of custom ARM-based server subsystems. Beyond domestic policy and monetary friction, geopolitical policy shifts represent the most direct operational challenge to ARM's global licensing expansion. Bureau of Industry and Security export controls enforced by the United States government directly limit ARM's ability to license its highest-performing Neoverse v2 and v3 processor IP. Intellectual property, patented microarchitecture designs licensed to chipmakers for upfront fees and royalties, to major Chinese hyperscalers like Alibaba. Historically, the Chinese market generated a significant portion of ARM's global licensing revenue. Regulatory compliance mandates artificially restrict high-margin architecture transfers to Chinese technology conglomerates, effectively severing ARM from one of the fastest-growing enterprise cloud markets in the world. As the technology Cold War intensifies between Washington and Beijing, Chinese state-backed enterprises are actively pouring billions into RISC-V development, an open-source, royalty-free instruction set alternative. While RISC-V server software compilers remain years away from enterprise-grade maturity, foreign trade restrictions act as a major catalyst for Chinese state-mandated architecture independence. On the social and political front, public backlash against massive corporate artificial intelligence expenditure is mounting. Institutional investors and regulatory bodies are demanding clear evidence of monetization from software platforms before approving multi-billion-dollar infrastructure spending packages. Furthermore, political scrutiny surrounding data center energy consumption is forcing local governments to impose strict environmental limits on power grid allocations for new compute facilities. This social pressure creates a structural advantage for ARM's power-efficient compute architecture. When municipal power grids cap data center power draw at fixed limits, cloud operators cannot simply add more power-hungry x86 processors. They are forced to deploy high-density, low-power ARM server nodes to maximize performance within fixed environmental constraints. ARM operates at the exact intersection of these opposing macroeconomic vectors, facing geopolitical friction on international IP licensing while benefiting from structural power limits on global compute infrastructure. At the lab, we trace every dollar of hyperscaler infrastructure spend down to the silicon IP level. Total hyperscaler CapEx reached $44.9 billion in Q2 2026, driven by GCP's $44.9 billion commitment. Hyperscaler capital expenditures flow directly into custom server CPUs and AI host processors, driving adoption of ARM's high-margin Neoverse v2 and v3 architectures. Each custom chip designed and deployed by cloud giants generates both upfront licensing fees and recurring per-chip royalties for ARM, making hyperscaler CapEx the ultimate leading indicator for ARM's top-line expansion. ARM reported earnings per share of $0.60, beating the Wall Street estimate of $0.59 by 2.1%. A solid beat that signals strong execution. Examining ARM's past 4 quarters, we at the lab see a distinct pattern of tightening consensus expectation. After missing EPS by 1.8% in Q1 2026, ARM posted a massive 15.7% beat in Q2. Since then, the beat margin has steadily compressed, stepping down to 4.6% in Q3 and narrowing further to just 2.1% in Q4 at 60 cents versus 59 cents expected. While the 3-quarter beat streak remains intact, Wall Street analysts have effectively eliminated management's upside cushion. ARM IP licensing is trading below its 20-day average at 200. Management leads with a clear PR narrative. ARM sits as the universal gatekeeper of global compute, taxing every AI rack-scale platform and personal computer on Earth. Their marketing campaign is designed to make investors feel that expanding royalty rates from the Armv9 architecture are an inevitable money machine. They want you focused on long-term AI hardware adoption while ignoring structural legal risks to their licensing framework. No qualifying executive statement in the last 6 months exists in the data, so the company relies on promotional releases to shape market expectations. What management wants you to ignore is the ongoing Qualcomm legal dispute regarding custom Nuvia Orion cores. If Qualcomm successfully forces a restructured licensing agreement or lower royalty rate, it creates a dangerous legal precedent. That precedent threatens to degrade royalty collection terms across every custom silicon developer using Arm's instruction set architecture. Look at the insider activity before believing the press release. While PR releases tout accelerating momentum, executives are quietly taking capital off the table. Meanwhile, retail interest is surging into earnings. Retail investors are driving momentum FOMO based on headlines about AI rack-scale chips. The crowd is buying the PR narrative, oblivious to the fact that top executives are selling into that exact retail liquidity. Behind the glossy press releases sits an aggressive spending profile that represents 56.4% of total revenue. Capturing higher royalties requires massive operational spending that severely restricts earnings conversion. Wall Street institutions hold 96.2% of the float, with top funds buying and Invesco adding 6%, as disclosed in their latest 13F filing. Short volume sits at 55.4% of daily volume, remaining strictly in line with its 57.9% historical baseline. Short sellers are not aggressively attacking, but market makers are heavily hedging into earnings volatility. What management is saying is that Arm is an unassailable AI toll booth. What the lab hears is an expensive IP licensee spending heavily to defend its moat while facing legal risk on its contract terms. The momentum breakdown for Arm. RSI sits at 34, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Arm's ecosystem royalty mode is structurally anchored by two unassailable hardware realities that competitors cannot easily replicate. First, the rapid architectural transition from legacy Armv8 to Armv9 effectively doubles Arm's royalty collection rate per physical chip, driving immediate high-margin revenue growth as mobile and edge processors integrate hardware features like SV2, Scalable Vector Extension 2, an architectural instruction set upgrade that doubles parallel data processing throughput for machine learning math. Second, hyperscaler custom silicon programs, including Amazon Web Services Graviton, Google Axion, and Microsoft Cobalt, are deep in multi-year design cycles built entirely around Arm's Neoverse compute subsystems. However, the bear case presents a formidable structural challenge that bulls cannot ignore, reflected in an elevated short float. Short float percentage, the proportion of publicly traded shares sold short by traders betting on a stock price decline, of 12%. At a demanding trailing P/E, price-to-earnings ratio, a valuation metric comparing share price to annual net profit, of 289.0x, and a forward multiple of 79.9x, the stock leaves zero margin for execution error. The critical question institutional semiconductor analysts are asking behind closed doors is this: can Arm convert its pure-play IP licensing model into sustainable net earnings growth when operating expenses eat up 2/3 of gross profit during broader semiconductor pullbacks? The lab's answer is definitive. Wall Street is misinterpreting where power resides in custom silicon design. While hyperscalers possess massive capital balance sheets, they are structurally trapped by their own developer ecosystems. Rewriting software stacks, re-engineering device drivers, and validating and proven open-source compilers would cost billions of dollars and introduce severe system downtime risk. Consequently, Arm retains supreme pricing power over architectural instruction sets, allowing royalty revenue to compound faster than operating expenses as Armv9 adoption expands across enterprise cloud data centers. Looking forward, two time-bound operational scenarios will determine Arm's business trajectory over the coming year. If Arm achieves sequential Armv9 royalty penetration growth past 30% of total royalties while maintaining standard contract enforcement across major licensees, IT will prove that architectural lock-in insulates royalty cash flows from broader hardware manufacturing slowdowns. Options market pricing reflects this uncertainty, with a bearish P/C ratio, put-to-call ratio, an options metric comparing put trading volume against call volume, of 1.79 and high implied volatility, showing trader demand for downside protection. Here's the macro picture shaping Arm target: 250 to 350 characters per bullet total, roughly 3 display lines each. Let's re-verify sentence structure for each. Sentence 1. USBS export controls limit licensing of high-margin Neoverse v2 and v3 IP to Chinese hyperscalers like Alibaba, suppressing licensing revenue. At Arm Holdings, we are witnessing the quintessential peak of this AI infrastructure cycle. The engineering moat remains formidable. Arm-based servers are actively capturing market share from x86 architecture, fueled by a relentless 56% R&D reinvestment rate. Management aggressively frames the business as the essential, energy-efficient compute backbone for next-generation AI rack platforms. Yet, with a trailing multiple near 290 times and put-call ratios rising ahead of earnings, valuation has disconnected from near-term execution. Over the next 2 quarters, Hyperscaler royalty rates will struggle to offset geopolitical licensing limits, setting up a transition into cycle digestion. Arm Holdings isn't leading the pack. It's running a different race, and the market's pricing it like a front-runner while the numbers still look like a middle-tier contender. Let's start with NVIDIA. The edge here is undeniable. 85.2% revenue growth versus Arm's 20.1%. That's not just a gap, it's a chasm. NVIDIA's gross margin of 74% crushes Arm's implied margin, since Arm doesn't disclose it, but industry benchmarks put it around 50 to 55%. That's not a premium. It's a bet on Arm's AI narrative outpacing NVIDIA's execution. Right now, the numbers don't justify it. Intel's the outlier. 90.3% YTD gain, but 39% gross margin and 25.4% revenue growth. Arm's growth is lower, but Intel's margin is a red flag. It's a foundry and chipmaker playing catch-up, and the market's pricing it like a turnaround story. Arm's implied margin is higher, but Intel's PE of 43.1x is still cheaper than what Arm's trading at. The edge? Intel's scale in x86. Arm's RISC architecture is efficient, but Intel's manufacturing muscle and government subsidies keep it in the game. Arm's not dominating here. It's competing in a different lane, but Intel's still a threat in AI data centers and edge computing. Qualcomm's the reality check. Negative revenue growth, 55% gross margin, and APE of 17.5x. Arm's growth is stronger, but Qualcomm's margin is a warning. Mobile royalties are a cash cow, but they're not growing. Arm's AI score of 88 to 100 suggests it's betting on AI inference at the edge, but Qualcomm's Snapdragon X Elite is already shipping in laptops. The edge? Qualcomm's ecosystem lock-in. Arm's licensing model is more flexible, but Qualcomm's got the OEM relationships. Arm's not trailing, but it's not leading either. It's trading like it's already won the AI edge race, and the numbers don't back that up yet. Valuation's the sticking point. Arm's PE isn't disclosed, but at $245, it's got to be astronomical. NVIDIA's 30.3x looks cheap by comparison, and Qualcomm's 17.5x is a steal. The market's pricing Arm like it's the next NVIDIA, but the growth rate doesn't match. Arm's 20.1% revenue growth is solid, but it's not 85.2% solid. The premium's justified only if Arm's AI narrative turns into execution. Right now, it's still a story. Capital efficiency's where Arm should shine. Arm's durability score just hit 88. No other chip architect comes close. Wall Street's missing the margin math. 99% royalty recognition on v9 licenses locks in 95% plus gross margins for years. That's not hype, it's die-level economics. Is the bull case or bear case stronger for Arm? Drop your thesis in the comments. This isn't financial advice. We're engineers, not brokers. Markets move fast. Past performance doesn't predict the future, and you should always run your own numbers. If you want our full breakdown on NVIDIA, the link is in the description. Hit subscribe to stay ahead of the silicon curve. See you in the next lab.